I'd like to welcome a special guest, Stanford Professor John Taylor, who, along with George Shultz, written an interesting book, Choose Economic Freedom: Enduring Policy Lessons from the 70s and 80s. I started to trade in the 70s. Welcome, Professor. I'll tell you what, I haven't read your book yet, but just by the title and skimming some of the things written about it, what an appropriate day. You know, here we are at a time where everybody wants the governments to help. Bank of England just cut rates further. They're going to be buying more. They have a special MP meeting. Christine Lagarde seems to have pulled back the notion. She's not responsible for the spreads of sovereigns against the high-quality boons, but yet, nonetheless, all these policies are coming. Nobody's complaining. But we really haven't settled up from what we did in policy-wise 8, 9, 10 years ago in the last crisis. How do you see this landscape, Professor?
Well, I think that there's some recent changes that are promising. Maybe that's what we're referring to. Some of these liquidity facilities just announced late last night and the day before by the Fed for the primary dealers, commercial paper, even money markets. Those are specifically focused on problems in the markets. So I think those are maybe more promising than some of the more general things that you've mentioned. And also, I think that's the spirit behind the book. Choose economic freedom. Choose things that work. Just don't throw the money away, and that can happen at times like this.
You know, and I couldn't agree more. Basically, we have 3 big programs by the Fed. I particularly like the short-term paper. I think that's very important, worked well in the last crisis. Now we have friend of CNBC, of course, you and I both know Larry Kudlow really well, top economic advisor, kind of put it out there that, you know, if they're going to create advantages for some of these businesses that need it or special loans, that there may be a cost associated with that. Equity positions. What do you think about that, kind of redoing what we did with GM, 10 years ago?
Well, I think some of the money should be focused on people that are clearly hurt, and that's it's going to be some low-income people. But I think the general sending lots of money that hasn't worked in the past. Quite frankly, 2008 there was a program of sending money to people that didn't do much good. The economy kept coming down. So I'd like to see some promises that, hey, how about no tax increases for a while? How about some regulatory moratorium for a while? Just those could be a boost. And I'd like to see a little bit more talk of that. You don't see much of that at all at this point. Instead, it's really talk about the third phase. By the way, I think the second phase, paid sick leave, testing payments, they make sense. But going on beyond that, it's a concern, and it hasn't worked in the past. So I hope they focus more on the problems.
Yes, no, I couldn't agree with you more. Big bailouts of large corporations. Hey, certain big businesses in certain sectors may need some help. Think airlines here. But I couldn't agree with you more. The average Joe on the street maybe didn't get looked after as well in the last crisis, and certainly seems as though that we really are aiming to help that particular group of people that we all know, whether it's my parents, your parents, friends. Mm-hmm. Now, final thought. We are seeing some of these spreads and some of the bad barometers of what's been going on ease back a little. Professor, can we actually see the market start to grab here because maybe it overcompensated? Your kind of thoughts on where the GPS of pricing is versus what we know about the horrible effects of the coronavirus?
The global side is important, and you have seen some increase in the medium to even 10-year rates in the last couple of days. I think the exchange rate is, you want to look at that as well, because the ECB has done some things. The ECB made some big decisions yesterday. One thing I think is important, they didn't change the rate, and they have a specific analysis of why. It's a good piece. The chief economist of the ECB just put out, Phil Lane, which explains, I think, more effort to explain what they're doing. That applies to the Fed as well. Will be very, very good at this point, and Lane's a good example.